if you look at there's 900 trillion in estimated assets in the world. And so we're like less than 1% for Bitcoin. Even gold at something like 20 trillion now is tiny compared to global assets. Some of the areas that are shockingly big are fiat currencies and bonds. I mean, there are hundreds of trillions of dollars of value, and I think a lot of that is better served in Bitcoin. And just people, obviously got high volatility, which keeps people out. It's got technological uncertainty. I mean, it's a 15, 16-year-old project.
Lyn Alden delves deeply into the global financial system in a recent interview, sharing her professional observations on the changing dynamics of the money supply, changes in liquidity, and the meeting point of monetary and fiscal policy. Alden talks on the importance of the money supply bottoming in 2023, the widening gap between monetary and fiscal policy, and the effects these changes are having on defensive assets like bonds and gold. She highlights the need of comprehending these dynamics in order to successfully navigate the intricate financial landscape of today, highlighting the possibility of rising volatility as well as opportunities across a range of asset classes. Alden also makes connections between Bitcoin and other decentralized assets and existing financial systems to clarify how they fit into this evolving ecosystem. To learn more about her ideas on the future and to keep up with industry trends, don't forget to like, subscribe for daily videos like this.
I mean, I think it's all of it. I think it's money. I think it goes through different adoption periods over time, right? So one of the first things it was used for is a collectible. People liked it because it was the best way of solving something that people have been trying to solve for a while. And then one of the first practical use cases was medium of exchange for WikiLeaks. When basically when other payments are shut down, here's this thing that can still work, right? But then the medium of exchange usage kind of stalled, or at least didn't grow as fast as many people thought. And I would say that's a couple key reasons. One is not everybody has payments problems, right? I mean, and I don't really wake up every day and think I'm trying to pay for things and I'm having trouble doing so, right? In certain jurisdictions, people have those issues. Throughout much of the developed world, not really, unless we're talking about international payments. And then in addition, most governments make every Bitcoin transaction taxable. Yeah, so you have this big accounting overhead if you want to use it like that. So that's not really where it's gravitated to for a while. And instead, the store of value property became pretty dominant, which is, okay, I want to hold this thing that they're not making more of and that is getting better over time as programmers keep building new layers and applications and things for it. And I think, at the long run, both are useful. I think generally speaking, it doesn't become a commonly used medium of exchange until people already have pretty large cash balances in it. And probably then the volatility is lower because if 10 times more people hold it, there's like less individual whales or leverage or offshore stuff that can just blow up and then, knock 10% overnight or 20% overnight or more. So I think as it becomes larger, more liquid, more people have these balances in it, they're more likely to want to use it. There's more people in a country that then petition their government to change the tax structure around it. Maybe you exclude the first, certain amount of transactions from being taxable or things like that, or you go full El Salvador and just make it legal tender. The total addressable market of good money is arguably the biggest or second biggest market out there, along with real estate, right? So, if you look at there's 900 trillion in estimated assets in the world. And so we're like less than 1% for Bitcoin. Even gold at something like 20 trillion now is tiny compared to global assets. Some of the areas that are shockingly big are fiat currencies and bonds. I mean, there are hundreds of trillions of dollars of value, and I think a lot of that is better served in Bitcoin. And just people, obviously got high volatility, which keeps people out. It's got technological uncertainty. I mean, it's a 15, 16-year-old project. So, nation states don't put their $1 trillion sovereign wealth fund aggressively into it until maybe it's 30 years old and it's 10 times bigger, right? So I think, and the way that I've described this before is that it has to reach certain thresholds before it even becomes interesting to higher thresholds. So back when the market cap was like $1 billion and it was pretty illiquid and literally one wealthy person could just buy in that day and move the price, that's not interesting to sovereign wealth funds or BlackRock or billionaires because it's too small and illiquid for them to even put a significant amount of their capital into it. But then when it starts to become bigger, and they can say, well, I can actually layer into this asset at a meaningful amount for me. Like I could be fairly certain that I'd be able to sell if I needed to because the liquidity would be there. And then higher level, then even bigger pools of capital can say, hey, this is actually, worthwhile being on our radar now. Um, and so I think I don't really look at it in terms of Bitcoin price. I mean, the unit numbers are arbitrary. The decimal point could have been somewhere else. And instead, it's more of like, what is the network worth? Right. So the fact that it's only like $1 trillion and change right now for market cap, I think is tiny compared to what it could be worth in 10, 20, 30 years.
In her explanation of the development of Bitcoin, Lyn Alden emphasizes how the cryptocurrency first came to light as a collectible and a means of payment for websites such as WikiLeaks. However, problems like transaction taxes and slow transaction speeds in wealthy nations made it difficult to use as a daily currency. As a result, Bitcoin became less useful for daily use. Rather, as people grew to appreciate its continuing development and scarcity, its function as a store of wealth became increasingly significant. Alden also touches on the expanding argument in favor of Bitcoin ETFs, pointing out that big assets frequently have ETFs to increase investor accessibility. The introduction of Bitcoin ETFs may increase acceptance and contribute to the wider mainstreaming of Bitcoin, particularly with a large price surge anticipated by year's end. ETFs would make it easier for retirement accounts and traditional brokerages to provide Bitcoin, bridging the gap between the crypto world and the traditional financial system. Let's dive into more insights from her interview.
I think they're inevitable. It's just like any big liquid asset is going to have ETFs. So if Bitcoin can't deal with ETFs, it wasn't even worth owning for the past 15 years, right? Now, you still have to think, okay, is Bitcoin good enough in a place, technologically speaking, that that holding it yourself is workable and attractive compared to letting someone else hold it for you? And if not, then what can be done to keep improving that in various ways? I mean, that's why I do Bitcoin venture. I'm a general partner at Ego Death Capital, so we're literally funding companies that are trying to improve the ecosystem in some way. But I think ETFs are inevitable. I think that basically they're pools of capital, especially in retirement accounts that literally don't have another way to get in. This is this is like they have a existing brokerage and they want to be able to buy an asset and they don't want to hold the keys. And I think that not everybody wants to hold the keys, kind of like how not everybody wants to fix their own car. Not everyone wants to, be a handyman around their house. And some people just don't really want to hold, they don't really want that sovereign property. And I think it's something worth monitoring. And then also like GBTC existed for years as a adjacent to an ETF, and it got over 600,000 Bitcoin in it at one point. And so a lot of this current ETF accumulation is just money flowing out of that and into other ETFs, which are still ultimately mostly at Coinbase. And so I think that there's risk of concentration, but it's not as big as people think because like it's not that much more coins in these things than there were 3 years ago when it was just GBTC. So I just think it's inevitable. It's pools of capital are going to do that. I've described this as like an API into the fiat system. People have these existing brokerages, and this was like an upgrade that the fiat currency system decided to make to plug into Bitcoin. It's not something that Bitcoin decided. It's something that the BlackRocks and the SECs of the world decided, and so they opened their system to plug into Bitcoin a little bit more than they did a year ago. So for the most part now, and I've been clear that I've been bullish on stablecoins for a while. The broader topic is just any like real world assets, right? So it could be tokenized gold, it could be tokenized T-bills, tokenized dollars. That's what a stablecoin is. Basically, there's in financial history, there's always been euro dollars, which is dollars that exist outside of the U.S. banking environment, not just in Europe, but elsewhere, even though they're called euro dollars. And stablecoins are just kind of the latest iteration of euro dollars. And there's a demand for it. And it's like offshore banking for the middle class, right? Because it kind of reduces the overhead of someone in Argentina or Egypt or Lebanon accessing dollars if they want that for whatever purposes they might want that. So I think stablecoins and networks that run stablecoins have relevance for probably quite a while. There's been interesting research. Like there are programmers on other networks that have, they've pushed forward the computer science of rollups and things like that eventually can find their way to Bitcoin in some capacity. So I think that it's partly going through this iterative process to see what works. There's a lot of scams there, obviously, but yeah, the short answer is that outside of Bitcoin and stable coins and these little kind of research niches, I've been publicly skeptical on the value of most of that other stuff.
Lyn Alden concludes by highlighting the fact that Bitcoin ETFs are unavoidable. She says that ETFs are likely to be developed around any sizable liquid asset such as Bitcoin. She makes the observation that Bitcoin's worth over the previous 15 years would be in doubt if it couldn't adjust to ETFs. Alden emphasizes that owners of Bitcoin should think about whether it makes more sense to allow someone else retain the asset through an ETF or whether it is still desirable to hold the asset themselves. She draws a comparison between the desire to maintain one's own car or handle household chores and the fact that not everyone is interested in keeping their own private keys for Bitcoin. ETFs give a lot of people, especially those who use traditional brokerages or retirement accounts, access to Bitcoin without having to deal with the technical difficulties of owning it directly. Alden agrees that there is a risk associated with concentrated assets in the hands of a small number of custodians, but she thinks it can be controlled. According to her, ETFs serve as a bridge that connects Bitcoin and the conventional financial system. It is not Bitcoin itself that is driving this growth, but rather financial organizations like BlackRock and the SEC. She concludes by discussing the significance of tokenized assets like gold and treasury bills, as well as stablecoins. According to Alden, stablecoins function as a contemporary equivalent of Eurodollars, facilitating dollar access for individuals in nations like Argentina or Lebanon, much like middle-class offshore banking. She emphasizes in her conclusion that she is skeptical of most cryptocurrencies, except from Bitcoin and stablecoins, but that she does see promise in several technical developments that could eventually help Bitcoin. Until next time, happy investing!